Hi, welcome back. So, are you ready for part 3 of Luke's story? Remember, Luke came in to visit with me and wanted advice about his 401k, but what prompted this discussion and wanting the second opinion is he had been presented with a life insurance-based investment strategy for his retirement. And he wasn't sure about it, and he wanted a second opinion. Good. Well done, Luke. Always good to get a second opinion when somebody recommends something, especially if you aren't sure about it or it just strikes you as like, I don't know if this is really appropriate for me. And when I looked at Luke's situation, I'll go ahead and steal my own thunder. It didn't make sense for Luke. And I think he kind of knew that. So when I talked to him about his situation, understood what he was trying to do, where he wanted to go, the things he wanted to accomplish. And Luke was very much on the front end of his retirement planning. So a life insurance-based investment program or retirement vehicle, to me, did not make sense for Luke, given all the other things that Luke needs to do. He's not married. He is saving to buy a house at some point. He doesn't really have any obligations well, let me rephrase that. Anybody who would be affected by his death, that's what life insurance should be for as a primary purpose. It can serve as other purposes, but that's its primary purpose. So when I looked at the situation, I said, Luke, the short answer is no. Now, I want to give you the benefit of the longer answer because I am running into this from time to time where I'm seeing insurance agents recommend a life insurance policy as an investment vehicle. In the right situation, with the right circumstances, all the right things included, it can make sense. However, I often enough see that it's being recommended almost like a panacea. You know, everybody should have one, right? So my perspective, and you can hear some of the hesitation in my voice, is because of this. From the 80s, 1980s, we saw the life insurance industry get a little too clever for its own good. The life insurance companies innovated and came out with new ways to use life insurance. And what they did, and this was back when interest rates were very, very high. In the early 80s, we saw interest rates easily in the double digits. CDs earning 14 or so percent. Life insurance policies with a cash value were being credited with 12 to 14%. So this was not unusual. This was the environment. And so life insurance companies started presenting these life insurance policies with cash value as a way to accumulate money for retirement. So not just as a way to efficiently provide life insurance. Put your money in, it'll earn interest. That'll help to reduce the cost of the life insurance or allow you to get more for the same amount of money. But they also started, again, in their cleverness to say, well, look, you can build this up. These interest rates will give you a large chunk of money in the future, and you can draw on that. And because it's life insurance, you pull out what you put in, that comes out tax-free. And then after that, you borrow money from the policy. That also is tax-free because a loan is tax-free. It's nothing special. Life insurance companies didn't create tax-free loans. That's just the nature of a loan. But they started to do this, and what happened is people gravitated toward this, and life insurance agents would present this as a viable supplemental retirement income, that you would put money into the policy, cram it in there as much as you could, and then draw your money back out, draw loans from the policies, and do this as a way to supplement your retirement income, tax-free, and then when you die, the loan would get paid back by the death benefit on the insurance. Everything clears out, you're happy, you've gotten tax-free income, and the loan is paid back, all good. The problem, and the reason why I'm telling you this story, is that it didn't play out that way. Interest rates went down. Policies did not accumulate the cash value they were projected to accumulate. Premiums that were supposed to stop at some point, you pay for 5 years, 10 years, then you don't have to pay premiums anymore. That didn't work out. Lawsuits ensued. It was ugly. So that's happened before. History lesson number 2. In the late 90s, yeah, in the 90s and then going into 2000, we also saw the advent of variable universal life, which was seen as a way to accumulate money for retirement. Same story, put money in, but this time you would have the opportunity of controlling the investments yourself. Instead of having the insurance company pay you a fixed rate like they did with the universal life when they had the higher rates, now you're in control. And with the variable universal life, you can direct the investment of the cash value of the policy, the money you're putting into the life insurance policy, you can direct it among sub-accounts, which are very much like mutual funds. So you're in control. You put money in, you plow money in, you fund it really quickly, you save this money for retirement, and then at retirement, you draw out of this variable universal life policy. Life is good. Cash comes back out, tax-free that you put in. Loans, tax-free. Same story. What happened in the early 2000s? We all know what happened. The stock market collapsed, going down 45, 50%. And if you were heavy in technology, 70, 80% down. What happened to these policies? You know what happened. They imploded. Premiums were required that weren't supposed to be required, or there was more premium required. The cash value didn't accumulate. What happened next? People weren't happy. Lawsuits ensued. Same story as with universal life. Okay, now we are now looking at another version of life insurance that builds up cash value. Index universal life. This is what Luke was presented. Now with an index universal life, the insurance company says, well, okay, let's not put the principal at risk by investing it in the market with mutual funds or sub-accounts. Let's give you the ability to have protection of your principal, meaning you only can earn interest, you can't earn negative, but you might earn nothing. So with Index Universal Life, same story. You put your money in, and what Luke had been shown he can do was put money in every year, have this saved for his retirement, and at his retirement, he would do what? You know what I'm going to say. He could draw back out what he put in, and then after that, he could take loans from the policy, and he would have a supplemental tax-free source of retirement income. And the agent was recommending this in lieu of or substantially part of his cash flow that he would be putting into his investment. So instead of putting as much as he could into the 401k, this vehicle was competing or would compete for the dollars that Luke would have available to go into his retirement savings. Now, what could go wrong? If the policy didn't earn the projected interest, then there would not be the cash value available when he was ready to retire and start drawing on it. So it may not work. Now, the jury is still out. It's way too early to say whether or not Index Universal Life is going to follow the footsteps of Universal Life in the 80s and Variable Universal Life in the late 90s going into the early 2000s. But I think we need to at least pause and say, is this a good idea? And is it something that makes sense for your situation? I'm not against life insurance. I recommend life insurance when it makes sense for my clients. I wouldn't be opposed to recommending this type of vehicle if it fit for the person's situation. But life insurance is life insurance is life insurance. You need to have other reason, and you need to need the insurance, and only in certain isolated cases does it make sense to look past the need for insurance to do something else with one of these products. Keep all that in mind, and you know what that means? You'll be able to plan stronger.